Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are in for a good and potentially a long one because today I am with Nelson from Canadian Dividend Investing, still in South Korea, still alive. That's interesting. Love the jersey. Unfortunately, at the time of recording, we know that the Jays lost yesterday. So are they playing tonight? And when people are going to listen, we'll know like the final verdict of that game. Or yeah,
It's game four tonight,
there
meaning
you go.
that if the Jays win, they're through. If they lose, then there's going to be a game five back in Toronto on Friday.
All right, so we don't know yet if you have to burn your jersey or not after this episode. So, anyways, we're gonna cut it short. We're gonna talk about utilities. We were talking pre-recording. There's probably a dozen of companies that are decent in Canada that probably deserve a small segment. I don't think we're gonna do the 12, but we're certainly going to try to cover as much ground as possible, but not go deep inside. But we're going to start with Nelson's favorite. When I suggested the topic, he actually started as like, I want to talk about talking this one right away. And I'm like, all right, so you're excited. I love this. So I'm going to let you introduce your favorite utilities and we're going to go from there.
Capital Power is a Alberta-based power provider. So it's a little different than some of the other utilities we're going to talk about that own the actual power lines and those assets. Capital Power just owns power plants. They're IPP, independent power producer. So they sell power to whoever wants to buy it, mostly kind of the grid, essentially. So mostly Capital Power has natural gas fired power plants. And they used to be coal fired power plants in Alberta. And then Alberta passed a law saying there's no more coal. And in exchange for that, Capital Power gets paid money until 2030. So basically, Capital Power took this money and along with other financing, and they used it to expand their business. So they bought natural gas power plants in like Arizona, California, one in the northeast of the United
Mm-hmm.
States, one in Ontario, and the market has sort of went from not really kind of caring about this. It was kind of natural gas was sort of this dirty fuel when everyone was very excited about solar and wind. And now the market is very excited about natural gas. Why? Well, because of AI and data centers. So essentially, Capital Power, Mike, we talked last week about what Toromont and how that's sort of like the picks and shovels version of investing in AI. Capital Power is very similar. It is the power that will be used to power these data centers. Alberta just announced that they're building one. So natural gas will be used to power it. Investors are excited, and Capital Power stock has done very, very well. I believe in the last kind of 3 years, it's gone from 35 to 70, plus it paid a very attractive dividend the whole time. So
Yeah,
that's
it's
kind of
it's
the
almost
thesis in a
up
nutshell.
90%. It's almost up 90% in the past 3 years, including the dividend. So we're up like 87 right now. So and huge run up has just happened right after what was it? Liberation Day, April 1st. Yeah. So
Mm-hmm.
after that crash, that small correction, then boom, it just exploded. And I want to have your take since you're on the ground in Alberta because I'm kind of surprised. We have this narrative around AI building, like producing, like forcing people to create a lot more data centers to compute all this information, and then we obviously need power. So there is this huge race to find that power. And it's kind of ironic because at the beginning of the year, I always write for my DSR members the themes of 2026 or 2025 this time. And one of the theme was the seek of energy propelled by AI. And what I find interesting here is a lot of companies like Power Capital, they look now, their utilities, they're supposed to be boring, just pay their dividend, operate in regulated markets. So they just see the regulator ask for a raise, and then that's pretty much the business model. But then you see how Capital Power is going up like there's no tomorrow right now. And I look at another one that is like mostly doing business in Alberta, still diversified, but the core business is there. Canadian Utilities is actually still that pretty little boring utility stock. So can you explain why Capital Power, and I get the idea, and this one was doing, it was doing fine before. Now it's doing even better because of that positive narrative. But Canadian Utilities are doing okay. But I mean, I've always seen this one as like almost too boring to care. Like I'm gonna go on with my favorite one after this one, which is not too close to that in terms of interest of excitement. But Canadian Utilities seems really to just offer like a 1% dividend growth rate. The stock price is not moving that much. So what's the difference between both?
Sure. So Canadian Utilities is you really nailed the criticism on that one because for the last few years growth has really been anemic. And you talked about that 1% dividend increase. You know, they technically have increased their dividend, which is I always joke that's the best kind of dividend, the technically increasing your dividend. Like we don't want that, right? We want good, solid, more than inflation dividend increases. So what's going on there? And considering too that Alberta is growing quite a bit, it's fastest growing province in Alberta.
Yep.
So what's happened is Canadian Utilities is mostly a utility in the rural parts of Alberta. So you've got Calgary, you've got Edmonton, the two major cities, which is where the majority of the growth is coming from. So what both of those cities own their own utilities. In Edmonton, we have EPCOR. In Calgary, they have ENMAX, and they own the all the power lines, they even own the natural gas utilities there as well. So what's happened is that even though Alberta has grown and Calgary and Edmonton have grown, Canadian Utilities really hasn't participated in that because the growth in rural Alberta just isn't there compared to the cities.
Mm.
So there is, you know, like investors are getting a little bit more optimistic about kind of rural Alberta. There's some growth initiatives that are there in terms of moving power up to the like the oil sands, things like that. So it looks like in the future there could be some growth there, and I think that's sort of why investors are getting a little bit more excited about that. Versus Capital Power, the growth story is very clear. It's hey, they've acquired this asset. Alberta's building this data center. It's very clear where the growth is going to come from. So that's kind of the difference there. Is that Capital Power is the much more obvious growth choice, but I think Canadian Utilities is a little bit, kind of in the background, doing some things that are getting investors a little bit excited again.
Yeah, and just before we move on to the next one, I want to highlight as well because I've heard that comments a few times about Capital Power since it was growing faster than most utilities. Is it going to be the next Algonquin? And I already know the answer to that is probably not. I mean, of course, we cannot foresee the future, but from my understanding is the metrics first are a lot stronger. They have this ability to grow, and while right now they have announced, if I remember correctly, it's like dividend growth guidance like between 2 to 4% because they're going to keep that capital allocated to the growth instead of just like sending money away everywhere. And one major thing is Algonquin finance everything with variable debt. It was more than 75% of their balance sheet was just variable debt. So when it went up very quickly, that kind of killed the business model altogether. While Capital Power is following the classic fixed bonds, fixed debentures, so you don't necessarily have to be worried about like short-term interest rate movement like it kind of killed the business at Algonquin. So I just wanted to like reassure investors in that regard. But nonetheless, it's going to be more volatile than a lot of other utilities. Actually, to be transparent, I'm not super excited about utilities altogether in general. If I look at my all my portfolios, it's slightly under 5% of my of all my investments. So I have like two major holdings that are split almost like two and a half, which are Fortis. And this is actually, in my view, the definition of a great utility business. Has been paying its dividend and increasing it for more than 50 years, well diversified between Canada, the US, and the Caribbean. Uh, 100% pure play on regulated assets. So really using that classic playbook of we're going to use our capex to improve our grid, improve our service, expand a little bit, and then we're going to see the regulators ask for a rate increase, and then we're just going to do it. And what I find interesting is they are able to do that and grow roughly mid-single digit year over year, regardless of what's happening. There's a recession, interest rates are moving, inflation is moving. We don't care. Like, we just follow the same playbook, we adapt accordingly, but we are able to actually make it happen at every stage of the economy. And this is the reason why I have it in my portfolio. I just don't want to follow it. I just like put it there in a black box, forget it for the next 50 years, and I know it's still going to chug a little bit of money, and bring stability to my portfolio since I'm 100% in stocks. So I don't want to. I don't know if you want to add something on Fortis, if you want to move to another one, but I'm going to leave it up to you on this one, Nelson.
I'll just very quickly add that Fortis is just it's defense, and it's as long as they don't screw up and they have a very good history of executing, you should get an 8 to 10% total return on that kind of forever, which is a nice kind of stable part of your portfolio. And then you can kind of swing for the fences a little bit, go for a little bit more growth on the other stuff. I think Fortis is like one of the best retirement stocks in Canada.
Definitely, definitely. Um, Talking about stocks that are going up fast, another one that hasn't received a lot of love before this year, Brookfield Renewable. There was a big a big frenzy in 2021, especially just before that. Brookfield, just so you know, they like to keep things complicated, if we can put it that way. So they keep on playing around with the different types of shares and different types of dividend, and they mix a bunch of stuff. And towards the end of 2020, Brookfield did a lot of like reshuffle of their businesses. And one major thing that they did back then is to create corporate classes shares for both Brookfield Renewable and Brookfield Infrastructure. So before that, you were able to buy them as partners in the US or trust units in Canada. But it's not getting much interest from institutional investors and ETFs and mutual funds, because it gets really complicated for taxes. So they decided to create another types of shares, which are corporate class shares, like the regular one, paying the dividend, and that's pretty much it. That created a lot of confusion at first already, because investors are just like, should I buy BEP or BEPC? And same thing for Brookfield Infrastructure. And one thing that's even more confusing is at first, the corporate class share, so the BEPC and BIPC, thrived. But I mean, you have to go back finance 101. I mean, what drives the stock price is more demand. So if all investors wants to buy something, it's going to go up regardless of what it is. So in that case, it went up very quickly. And then after 21, that was just dead money for like, yeah, until recently, actually. So Brookfield Renewable, up 38%, including the dividend this year. What is fascinating there, and the reason why I kept my shares even though they were not performing, is the numbers have been good this entire time. They grow their revenue, they grow their FFO, which is the most important thing, the funds from operation. They grow their distribution. Their FFO per share is growing, and their payout ratio is well in order. So I like the fact that A, it is well managed. B, incredibly well diversified in terms of geographic and source of power. I mean, they're doing everything. They're doing wind, solar, hydro, they're doing storage, and they're present in North America, South America, Asia. They're everywhere, and they're backed by the Brookfield Corporation as well. So really like this kind of business. I'm a patient investor, and this requires patient capital. I would put it that way. So I know a lot of investors, they throw the towels because they look at the stock price, and at one point they get fed up. But I never look at stock price to determine if I should sell or buy. I look at the metrics and the thesis. it has been strong and steady, and this one is definitely benefiting from the data center. They ink deals with Google, they ink deals with Microsoft, all related to powering those data centers for the cloud, for AI, and so on. So I can see this run keeps on moving up. So I don't know, what's your take on Brookfield on this one for Nesson?
Yeah, they're very natural partners when it comes to a Microsoft or a Google, because Microsoft can then go to their shareholders and they can say, "Hey, our data center is powered by hydro or whatever," and that's a lot more palatable for the average shareholder versus, "Hey, we got this natural gas plant that's
Yeah.
so it's more environmentally friendly." What I'll say about kind of Brookfield Renewable in general is, what I like about them is that they're willing to. There's a little bit of, you talked about the Brookfield management aspect to it. They're more willing to kind of sell assets that they think are
Yes.
maybe a little bit expensive, take that capital, recycle it, put it into something that's cheap, and kind of repeat the whole process. And as long as they're good at it, and they have a record of being quite good at it, they can add some value there as well. So you've got, kind of these assets that they hold, that they should hold for a very long time, and then that kind of opportunistic um, aspect of the company as well, which should help increase returns over time. I think it's about, what, 6% distribution growth over time, which combined with the yield, that's a nice combination. You won't get that in many more stocks in Canada, even after it's moved up quite a bit.
Yeah, and while other renewable utilities have skyrocketed in 2021, Brookfield seems to be the only pure play on renewables that actually had a sounded balance sheet and a profitable model. So we had the Energex, the Northland Power, and all of that. And then there, even Northland Power comes and goes in my questions during my webinars, because there's always this, oh, I want to make a play on a narrative, renewable AI data centers. There you go. I'm gonna, but I mean, before you go to the narrative, you have to go to the financial metrics. I mean, if the business model is not that great, it's not because, I mean, it's like a hockey team. It's not because you have a new logo and you have like a new Coliseum that you're going to win more games. I mean, you have to look at the lineups first. So it's the same thing for stocks. I mean, if the business has not the ability to generate profit, yes, there is a great narrative, but you're taking a huge risk. All right, so we're getting close to the 20 minutes. Want to talk a little bit about Hydro One. One that is kind of like the, I don't know if I could put it this way, but uh, anti-utility stock, in the sense that it's growing, but the yield is super low, which it's not necessarily what you see. Usually when you think about utilities, you're thinking about like 4 or 5% yield. This one is like at 2.70 as of this morning, mostly because the stocks keeps on going up. It's a relatively new dividend pair, maybe like 6 7 years now, but everything goes up clockwork, which is quite impressive. So they are, of course, based in Ontario, a combination of nuclear power and hydroelectricity. I would say probably the downside that I see here is it could get very political, because the government of Ontario owns a good share of that. And it's kind of ironic, because in Quebec, we have Hydro Quebec that is still 100% owned by the government. And there's that narrative about, what if it goes public at one point and we could just unlock some value. And I see what Hydro One is doing, and I'm like, yeah, I would probably buy some shares of Hydro Quebec if I could, because it seems to be a pretty solid business. Especially, I mean, similar to what is happening in Alberta, Ontario, like very great diversified economy, usually growing, doing well. So if I was interested in adding another utility stock to my portfolio, I would probably go for Hydro One. What do you think, Nelson?
I think Hydro One is, they've done a really wonderful job on the growth aspect. Like you said, they're growing probably faster than any other utility in Canada. That includes Brookfield Renewables, which is pretty impressive considering that Brookfield Renewables can look around the world for assets.
Hmm.
Hydro One is just in Ontario. But what I view Hydro One as is they, besides the assets you talked about, they own the grid in a lot of these smaller towns that surround sort of Toronto that are maybe like 2-3 hours outside of Toronto. So I view it as, I think those towns continue to grow as sort of more and more people get away from the rat race that is Toronto, and those towns grow. What happens? Well, people need more power. Electric cars there also, I think more people will go in that direction as well. So you've got that aspect to it, and I think that those communities will continue to grow, and that'll be a nice tailwind for hydropower. And then, of course, they've got the big transmission lines that transmit from the big power plants into Toronto. They don't own the grid in Toronto, but they've got those transmission lines. And so it's also kind of this play on Toronto as well. I'm less bullish on Toronto, but I think that more people, there will be more power consumed inside Toronto, which bodes well for them over the long term.
Yeah, definitely. So, quite an exciting time for utilities, but always keep in mind they're not known to be growth stocks. Similar to what happened in 2021, where a lot of renewable utilities were going up like there's no tomorrow. I warned investors, I mean, they're supposed to be stable, pay their dividend, and just rinse and repeat their playbook all over again. So, if you get too excited about the search for power in this narrative, you may burn yourself. And keep in mind, whenever interest rates will go up, utilities are going to take a hit. They're going to take a hit because they're capex heavy, but also because a lot of investors that are looking for yield are going to go back to bonds and GICs and cash their profit. And they're typically buying stuff like utilities. So just keep that in mind. It's not a perfect world. I think we did a pretty good overview today of the major player. We skip Emera, but at one point, I mean, we cannot go for an hour. Still the main one were covered. So Delson, once again, thank you so much for being part of the Moose. We're going to take a break next week, but not because I don't want to talk to you and not because you're going to be frustrated about what's going to happen with the Jays game, but because I'm having a home renovation and I don't know if I'll be able to record. So there will still be a Moose on the Loose next Thursday, not just with Nelson, but we're going to have him back. So don't worry about it. In the meantime, you can subscribe to his newsletter at Canadian Dividend Investing, the Canadian Dividend Investing newsletter. And we're going to talk again tomorrow. So until then, don't forget to stay invested.